So welcome today to Small Business Accounting Basics to save you money. So we're actually going to do an overview of accounting, bookkeeping, and finance. Today it's presented by Jeff Dussault, who's a CA and has actually been in practice now for 25 years plus, so over 25 years. So we get to leverage his experience. And at this point, I'm going to pass it on to Jeff.
Thank you, Carla. Thank you for the introduction, and thank you for the opportunity to talk to everybody today. If you want to switch the slides. I'm going to talk today about I've broken it down into three areas: taxes, bookkeeping, and finance. On talking about taxes, most of my clients know how they are doing with their small business. What they need from me is help in tax compliance and planning. But the less money that you pay in penalties, tax, and interest, the more money you have to live or to reinvest in your business. Tax compliance is the filing of returns correctly and on time. Tax planning is the organization and structuring of business and personal affairs to achieve the minimum tax and maximum deferrals allowed while achieving the goals and objectives of the taxpayer. Penny saved really is a penny earned. Next slide. So talking about filing deadlines, always try to comply with filing deadlines. The most common are payroll deductions, HST, which is the Canadian sales tax on goods and services, corporate income taxes, and personal tax installments. Many of the penalties that you get that are applied to you are instant and severe, being as much as 5 or 10% of the tax is owing. Plus, then you're charged interest on that penalty as if that penalty was incurred at the due date. For example, if you owed $10,000 in corporate income tax and the return was due October 31st, even if you've only filed 1 week late, that penalty is still $500. There are also similar penalties for HST and payroll taxes. Next slide. Now, some small business owners worry that they don't have the money to pay the tax when it becomes due, so they don't submit the returns on time and incur late penalties. But doing nothing is not a solution. A better solution is to file the return on time, pay what you can, and there will be interest on the rest. This is better than a penalty, and then interest on the penalty as well. Next slide. The other not as common situation is that bookkeeping isn't ready to compile the information in time, so you wait. But a better solution is to pay an estimate before the deadline. Any overpayment would be refunded when the return is actually filed, but the advantage over doing nothing is that most of the penalties for non-filing are based on the amount owing. So if you've paid all or most of the balance, the penalties can be significantly reduced. And if you're incorporated, don't file the corporate income taxes too late, even if you're sure you have no taxes owing. You could lose the ability to minimize and defer your taxes. If you haven't filed in several years, there could also be other problems accessing credits and refunds that you might otherwise be entitled to. Next slide. Okay, that's fine. Some tips on taxes. Don't do your own taxes. Many people are too conservative when they do their own taxes. The thinking is if they don't take all the deductions they are entitled to, the tax authorities will leave them alone. Unfortunately, it doesn't work that way. In the meantime, you pay more tax than you might otherwise need to. Clients often ask me whether they can write off this or that expense for their business. My usual answer is it depends. This is not just because I want to stay out of trouble. It really does depend on the situation. What I often go back to is the basic tax principle, which is that in order to be deductible, the expense has to be incurred to earn income. That has to be the purpose of the expense. In other words, if you didn't consume something or spend something in the pursuit of earning income, then you can't deduct it. End of story. And some of the best deductions are ones that you are already spending anyway. Common examples are office and the home expenses, car expenses, or travel. Next slide. Talking about bookkeeping, do the books on a regular basis. If you are doing them yourself, it's easier to keep up if you do it every month. If you use an outside service provider, then the timing will usually be based on how often you need to report to comply with HST, payroll, or other taxes, usually quarterly or monthly. In order to save yourself time and money, consider using an integrated bookkeeping package such as QuickBooks or Simply Accounting to keep your records. You don't need a full understanding of accounting to operate them, and it should save you time. The major difference between the two is that QuickBooks lets you delete or amend entries after they're made, while in Simply, once an item is posted, it can't be changed. QuickBooks is usually found to be easier to use, but either way, I recommend that you spend some time or money up front in having it set up to operate optimally for your particular situation. Most of the bookkeeping packages allow you to prepare invoices and allow you to customize them. The advantage is that the sale is recorded in the books at the same time you have to prepare the invoice. The same thing is true of writing checks or doing payroll. If you automate your process in one of these accounting packages, you will be recording the transaction at the same time as you are preparing the invoice or check, so it won't have to be done again. The important things are to A, enter all your transactions that have gone through the business's bank account, and don't forget about business expenses that you have paid personally. It's best if you treat the business as a separate entity and try to minimize mixing personal and business. Sometimes it can't be helped, but use a spreadsheet to record your personal expenses, including HST, so they don't get forgotten. It will also save your accountant time when they prepare your year-end if as much personal expenses are already recorded and the business's bank account reconciles to the accounting records. And if it's not possible for you to do the bookkeeping because it's just not in your DNA or you don't have the time, then hire someone else to do it. Some accountants like myself offer bookkeeping services in-house, and there are lots of freelance people that will often come to you. When it comes to finding an accountant, you should ask for recommendations from friends or business associates. When I meet prospective clients for the first time, it is obvious that the level of trust that they have in me is much higher when there's been a good referral from an existing client or a business contact. Your accountant should understand your business and, more importantly, understand your goals and aspirations for your business and for your life. Next slide. Finance. It's important to have enough working capital to support your business plan. Remember that often the faster the business is growing, the more working capital is needed. Picture that your business is building bicycles. If you're building 10 bikes, you would have to purchase the equipment and pay the labor to manufacture those 10 bikes. You may or may not be able to get credit for the materials, but certainly employees expect to be paid on a regular basis. Then you have to sell the bikes, invoice, and wait for payment. You've already spent the money, and you won't get it back until your customers pay you. Now, instead of 10 bikes, imagine how much more credit you will need if your next order is 100 bikes. For that reason, look for credit from banks, even for small amounts to start. It doesn't mean you have to use it right away, but if you have that credit available, it's there when you do need it. And it's always better to ask for the credit when you don't need it. Strange thing. If your business requires a lot of credit, ensure that the interest paid will be a deductible expense. It's important to structure the loan or line of credit so that the business is borrowing the money and not you personally. When you usually go to a bank, they'll have difficulty lending money to a new business or a small business that have new or few tangible assets. And they'll often try and steer people to just taking out equity against their homes. But this is a mistake from the perspective of having the business deduct the interest paid. Often the bank can be persuaded to lend the money to the business if the owner will guarantee the loan personally. Now, we haven't spoken about types of business structure, as that's really a subject that deserves its own session. No matter what else, setting up a company is recommended when there's a possibility of a legal liability from the business that can be separated from the personal assets of the owner. In other words, if the personal wealth and assets of the owner can be separated from potential liabilities of the business, then incorporate. This applies whether it's a financial liability, such as a lease for premises, or a liability for negligence for services or materials supplied. Next slide. You might be able to look for discounts on supplies and purchases for early payments that will save you money. You should deposit checks as soon as you receive them and space out your payments to suppliers as much as you can. However, it's better to borrow money on the business line of credit than be late in paying taxes. The government charges about 5% interest, but it's actually higher than that because that is normally not a deductible expense. So you have to earn more money to pay the 5%, whereas if you borrow money on a deductible loan, you can deduct that interest. Next slide. So finally, the key takeaways are: don't do your own taxes, avoid penalties and interest on tax compliance, and keep your books up to date. Thank you, and if anybody has any questions, please type them in.